It's been an eventful year for global fixed income, with big swings in yields, surprising political shifts, and renewed questions about the path forward for rates. To make sense of it all and to walk us through what happened, why it mattered, and what it could mean for 2026, I'm joined today by Shriya Samarth, G3 Rate Trader at StoneX. Welcome, Shriya. How are you?
Hi, I'm good.
So let's start with a recap of 2025. What are some of the themes that we saw in the bond markets this year?
Sure. Well, there's certainly been moments of volatility and then lack of it. But I'd actually like to start by talking about my outfit. I am wearing Pantone's 2026 Color of the Year Cloud
You
Dance. You
are.
are as well,
Yes.
which is an iteration of white, and there was a lot of backlash about it on the internet that white's really boring and neutrals aren't it. And
Off-white.
yeah,
Almost cream.
like a billowy, soft white. Yeah, I disagree, and I think it's a good metaphor for the bond markets.
Okay.
So I'm here to
I love
dispel the myth that neutrals are boring. They can be anything but they can be pretty exciting. And we saw that in the bond markets this year. Overall, we've seen the curve steepening with drivers from both ends. So in the long end, we had a bit of a reckoning this summer from an ill-fated Japanese government bond auction, which led to higher yields that we're still seeing right now. And then in the front end, we've had a lot of lower rate rhetoric from central banks like the Fed, the Bank of England, the European Central Bank. Then on Liberation Day, we saw a good example of volatility, especially in U.S. Treasuries. That was a wild day. There were a lot of concerns about what the impact of tariffs would be on growth, and we saw U.S. Treasury yields in the 10-year space fluctuate as much as 60 basis points over a couple of days. That is a lot. Normally, they only fluctuate like a couple of basis points over that whole time period. But I think it's important to remember that bond markets love volatility. That's how they came to be. So in the 1980s, bond traders weren't really considered cool until a little bond market renovation took over. They were considered kind of boring, bit cloud dancer, off-white. But then they had a certain surge of interest. You know, bonds went from becoming an instrument that you use to lock in safe gains and hedge your interest rate exposure to a speculative product that could make huge profits, especially in the mortgage-backed security space. That happened because of volatility driven by two main reasons. The first is in 1971, President Nixon unpegged the US dollar from the international gold standard, which introduced volatility into the market, but also opened up some space for flexible monetary policy. The second driver was in the 1980s, we had peak interest rates of about 20%. And that was under Chairman Volcker's rule, where he was combating loads of rampant inflation from the 1970s. The combination of those two factors, as we now know, introduced volatility and made bond trading exciting again. So between what's happening now in 2025 and what happened starting from then, we know that moving rates and reactive central banks as a combination create volatility and they create opportunities in the markets. So the StoneX Rates desk and the StoneX Mortgage-Backed Securities desk, based in New York, both have decades of experience, some of them tailing back to the end of that bond market renaissance. And we also have healthy balance sheets that can help our clients take advantage of this liquidity when there is volatility and even when there's not.
You briefly mentioned there the long end sell-off of the 20-year Japanese government bond auction. What triggered that move? And is it related to the same higher yields that we're seeing again?
So today we've entered into a bit of a fearfully hawkish environment where we are seeing higher yields partly because of what happened this summer and partly as a reaction ever since then. What I mean by that is just earlier this week, the European Central Bank had a speaker, Actionable, who stated publicly that she believed that the next move from the ECB was going to be a hike, not a cut. And that was a pretty big statement. Even though it was just one person, the bond markets did overreact to that. And that morning, the 2-year German Schatz opened up higher by 3 basis points in terms of yield. Then just yesterday, we had the same situation happen in Australia, where the Reserve Bank stated that there are inflation risks on the horizon, and therefore it's possible that they don't need any more rate cuts. And the markets interpreted that as hawkish, that, oh, we're raising rates now instead, and yields shot up in the region as well. Globally, we're embracing a sentiment that when we stop easing, it's a hawkish sentiment that we're actually hiking. But that doesn't necessarily have to be the case because there is the pause option, which the markets are kind of ignoring, even though this was the prominent option post-global financial crisis and post-European sovereign debt crisis for a lot of G3 economies. Going back to, the color of the year, I think the bond markets are so afraid of being boring that they're forgetting that pausing is actually an option on the interest rate path instead of just cutting and then hiking. Yeah. But going back to what happened this summer, in May this year, the Japanese government bond 20-year auction did not go well at all. It was the longest tail, lowest demand since 1987. Yields shot up 15 basis points on the day in the 20-year, and in the longer dated securities, yields actually reached an all-time high. Decades of low growth in Japan, despite lower interest rates that should be spurring that growth along, really forced a reckoning of the long end. It questioned the very concept of the risk-free rate and if that is correctly priced into the markets. And that concern, that sentiment, spilled over into U.S. Treasury markets, into European government bond markets, and the gilt market as well. It's still very prominent today, that concept of, are we pricing in risk correctly? Are we pricing it in enough? Suddenly, we now have bond market vigilantes that are punishing governments for fiscal profligacy and reckless leveraging by demanding higher yields from their government bonds in order to invest.
Can I just say that this year has been anything but boring? I mean, in fact, it's been filled with uncertainty, so much so that we've had actually different political leaders come up. I mean, well, that was not uncertain, but we had President Trump. We also had several French governments. And now we have a new prime minister in Japan. So what have the bond markets made of all these changes?
There's been a lot of change in leadership for sure, and every time there tends to be a need for those leaders to put a stamp on their own fiscal policy in order to define themselves, and that can trickle into bond market yields in a couple of ways. The first is inflation risk. Some of these policies can be net inflationary, like we were concerned that tariffs were when Trump announced that earlier this year, and they can also cause yields to rise if borrowing costs aren't being contained. We saw that in the UK gilt market when we were concerned that Chancellor Rachel Reeves's budget was not going to be able to meet revenues in and of itself. Right. Japan's new Prime Minister Takaichi, she's a great example of trying to make that mark with her fiscal policy. She's a student of Abenomics, so she believes in low monetary policy, lower rates, and expansionary fiscal policy, and the combination of which she wants to use to drive domestic growth. Now, she's been compared quite a few times now to Margaret Thatcher, and I hope in a bit more nuanced way than just the fact that they're both conservative female prime ministers. But my favorite comparison about the two of them is that they both love handbags. Margaret Thatcher was known for the political term handbagging, which was when she would figuratively, I hope, defeat her opponents by hitting them with a handbag. And she was always seen to be wearing Launer, which is a British brand that the Queen also loved. They both had a little bit of a rivalry going on, but they both loved the suede line top handle handbag. Margaret Thatcher used to put all her government documents and notes in there, and at one point it was considered the safest place to keep government documents because she never let that handbag out of her sight. Takaichi was recently spotted wearing her favorite leather tote of choice, a brand from a not as well-known designer called Hamano. It's gone viral actually since she wore it, and it was on the New York Times. It's probably sold out by now as I'm talking about it. Yeah. But it says a lot about her and her personality. She is not wearing a Louis Vuitton. She is wearing a homegrown Japanese brand made in Japan that a lot of people didn't know about because she's making a political statement and an economic statement. She wants to support the domestic economy. As a fan of both fashion and finance, I truly believe that handbag preferences can determine if we're about to see a curve steepener or not.
Tell me how.
Whenever a fashion-forward politician, male or female, is promoting their own local brand and dressing in their own local homegrown clothing, it sends a signal that they're going to focus on domestic growth as a priority above anything else. That generally means that rates should rise in the medium to long term because the economy is going to be running a little bit hot from the domestic growth promotion, and that's going to need higher rates to adjust for that. We will probably see this most obviously in the 2-year, 10-year curve,
Okay.
because that medium-term bit will likely have to have higher rates to account for the growth that the economy is going to go through if successful, and also lower rates supports domestic growth a bit more because it just spurs the economy when you don't have the opportunity cost of just chucking money into a bank account. You can use it to buy handbags. So I think that's something that I would expect to see whenever I see a politician carrying their favorite local handbag. And that's what I'm predicting is going to happen to the Japanese yield curve based on what I've seen in fashion lately. So we've got the Big Mac index, and CPI itself is a measure of a basket of goods and services, but I think it'd be really interesting to also see what effects handbag demand and designers can have on curve dynamics.
Can I just say I love all the fashion analogies. And just so you know, that color that you're talking about, Cloud Dancer, looks great on our skin tone, so I'm going to go with it. So how can StoneX help position clients for the year ahead?
As a fan of both fashion and finance, I do believe in diversity and curating the right collection. So in terms of fashion, I see the value in everyone owning a bit of British wool, everyday cottons, maybe Mongolian cashmere. And the StoneX Rates desk, I believe, has a really strong global collection of expertise. We're not just a liquidity provider. We also have excellent market commentary and insights into what's happening in the markets and why. So we can best advise on the best value trades for our clients depending on what they're after. And that can be really nuanced. It doesn't always have to be that the benchmark commonly traded liquid instruments in the US Treasury curve are the best things to trade right now. Sometimes it can be off the run, more illiquid counterparts, or even, statement outfits. You're looking for like a discount US Treasury bill. You might get the same yield pickup if you looked into a short coupon instrument instead. These are the kind of dynamics that we hope to offer our clients in addition to our fantastic round-the-clock liquidity. So we're here to help our clients mix and match their portfolios as much as they'd like, and we're here to offer fashion insights as well if they want them.
Shriya, thank you so much for both insights on today. And thank you so much to everybody that's watching. For more financial content, don't forget to like and subscribe to our channel.